From Tycoon News Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
And the next thing that we're going to be talking about are the vertical spreads, one of my personal favorites. The first one we're going to talk about are bull spreads. Why don't you tell us the advantages of a bull spread?
Well, there's a few advantages the bull spread has. First off, it's definitely cost efficient. You know, when you have a stock like a Google, not everybody can trade a Google $500, $600 a share. However, when we talk about a spread, we know that say if the spread between the strikes and Google is $10, we know we can buy and sell spreads in between those $10 that will be less than $10, allowing you to trade more expensive stocks. They're also great in high volatility situations, and they have a great return on investment, and they're fully hedged.
Okay.
And, I mean, I can go on and on.
Well, let me stop you before you do that, because that would be a big mistake for me to let you continue to go on and on, because then I'd have to listen to the rest of what you're saying. So let me stop and ask you a question very quickly.
Okay.
You're saying that there's a great return on your investment. So are you telling us that we're using lots of leverage here? Are we getting into dangerous territory?
No, you're not, because it's a fully hedged strategy. Your problem with using too much leverage is the fact that if you use too much leverage and you're not protected, then you've got problems. Here in the bull spread, we are in a fully hedged position. We know that whatever spread that we trade, and, well, you don't know it yet, but you're going to find out soon, that whatever your spread you trade, the maximum value of that spread is limited to the difference between the two strikes you use. So if you're using the 55 and 60 strike, that's $5 difference. The most that spread can be is $5. As always, you have to make sure that you never spend, put too much money in the market in any position. Really doesn't matter what position we're talking about or what strategy we're talking about. You always have to have control of that. But the return on investment is very nice because it's a small amount of money in for a small amount of money potentially back out. But when you're talking about a $5 spread and you pay $3 for it, it can go to $5. You can make $2 when you spend $3. That's a 66% return in a month.
Right. I mean, kind of like what I was talking about before when you say that when it comes to stock trading, you're either dead right or you're dead wrong. Here, if you have a stock at 50 and you don't think it's going to trade higher than 55, well, you can initiate spreads and make money that way. If you have a stock at 50 and you don't think it's going to trade any lower than 45, then you can make money that way using vertical spreads.
There is also a premium collection component to the vertical spread, and the thing you need to know about that is it really doesn't matter whether it's a debit or credit. Spreads, debit, credit, doesn't matter. Premium collection is about theta, and that's what you have to make sure that you monitor. If you have a long theta, normally means you're selling the option that's closest to the at-the-money or the at-the-money itself, you will be collecting premium.
Man, that sounds like a bunch of bull spread.
It is a bunch of bull spreads. But the nice thing is they're also very high probability. Because if you have the premium collection working for you, you can make money now if the stock goes in your direction. You can also make money if the stock stays still. And that gives us another way to make money. We might not time it right, and we don't get the movement we want as fast as we wanted it. But if we have the right spread on, built in premium collection style, we can still make money even if the spread doesn't move or goes against us slightly.
Right. So, I mean, a lot of stock traders, what they'll do is they'll say, I think the stock's either going to go up or it's going to go down. But there are a number of things that can happen, to a stock. And a lot of the times the stock traders will see that they think it's going to trade higher, but not by much, and vice versa. And they don't know how to take advantage of that. But you're going to show us how to do it now.
I'm going to show you right now.
Bull spread.
You got it. Let's take a closer look at the vertical spread strategy, starting with the bull spread. The bull spread is aptly named because it's a bullish spread. That means we're going to benefit from the stock moving up. Two different constructions for the same trade. Now, functionality. This is a bullish trade. No matter what you hear from anybody else, a vertical spread has a delta that makes it directional. And you've got to remember that. Whether you're doing a debit spread or a credit spread, if it's a bull spread, you have a long delta, and that means if the stock goes down, you will get hurt. If the stock goes up, you're in good shape. So we're looking for a bullish movement in the stock, an upward movement in the stock. We also know that there's a fully hedged position. Because we're net neutral options, we've bought one and we sold one, we're in a situation where we have a limited loss and limited gain scenario. That means this spread is fully hedged. When we're buying the call spread, we can only lose what we spent. When we're selling the put spread, the long put that is in our construction eventually limits any type of loss that the short put has. So we are going to be fully hedged. There is a maximum gain in this strategy and a maximum loss. You'll never gain more than the maximum gain. You'll never lose more than the maximum loss. Fully hedged. Now, it's a very cost-efficient strategy. Bull spreads are very cost-efficient. They don't cost much money to do. If you were trading Google, for instance, and you decided, hey, I really want to play this stock, but it's $450, $500, $600, $700, you have the ability to use the vertical spread, and here the bull spread in particular, to be able to trade Google. Because now when you're looking at these spreads, you're looking at, $7 and $8 and $5 and $2 of expenditure, not $400, $500, $600. It's also phenomenal use in high volatility situations. One of the things is that when we try to trade directionally, we know that with our stock replacement strategy, we're going to be a buyer of an option. But when we're a buyer of an option, we're going to be picking up some extrinsic value, aren't we? And we know that extrinsic value decays. Well, when volatility is high, volatility adds extrinsic value into our option. And if we now have additional extrinsic value in the option that we're going to use, and volatility goes down, we're going to lose money, because then volatility coming down is going to suck extrinsic value back out. On top of that, even if volatility stays up, theta will start attacking that additional extrinsic value. At some point in time, after vol goes up, the premium, the extrinsic value that vol has put in is going to have to come out. No doubt about it. And if it does, our option is going to lose. So in a situation where I want a directional trade and volatility is very high, vertical spread is the way to go. And we're talking about the bull spread right now. Great to use in high volatility situations. We also have the ability to construct this bull spread in a manner that we are a premium collector. Remember, when we go back to our Greeks, we think about theta, time decay. And where's time decay the largest? We know time decay is the largest at the at-the-money option in any given month. And we know that if we move in the money or out of the money in that month, each one of those strikes has a lesser theta. So if we want to be a premium collector, we know we want to be a seller of the at-the-money option. In the bull spread, if we buy, say, an in-the-money option with a smaller theta and sell the at-the-money option, we will have a positive theta. That means this bull spread can be constructed to be a premium collector. It has a high probability of success. You're going to learn how these different vertical spreads and bull spread, the credit and debit trades, you're going to see that these spreads, some of them trade for a premium, others trade for a discount off their intrinsic value. That gives us a high probability of success, because if constructed as a premium collector, the vertical spread not only wins if the stock goes up, it also wins if the stock stays still. And it can still win even if the stock trades against you, and that would be down. So it's a high probability of success trade. Let's take a look at the profit and loss of our bull spread here. First thing we have to do, as always, let's find our break even. What's our break even? It's the point where the position neither makes or loses money, the place where you break even. We also need to talk about the point of maximum profit. Where is the spread going to have the maximum profit? Remember that rule of thumb we talked about? About, hey, if I was short an option, the one spot that I'd want the stock to go would be to the short option. And if I was long one, I'd want it to go as far away from the long strike as possible. Well, our maximum profit is going to be found with the stock right at our short strike. And our maximum loss will be found right at the long strike. Let's first figure out this whole break-even mess. What do we have? We've got a long call spread, debit spread. If we're in a debit spread, that means we actually paid money for the spread. It means in this case, we're long the lower strike call and short the higher strike call. The way we get our break even is very simple. We take the long call strike, which is going to be the lower strike, and we add the spread price. So if we, for instance, bought the 25-30 call spread, buying the 25s, selling the 30s, and it cost us $3 to do it, then we would take that lower strike call, the 25 strike, add $3, takes us to 28. 28 will be the break even for this long call spread. What about the short put spread? The short put spread, although the same trade as the long call spread, the short put spread is giving us a credit. We're taking money in. Why? Because we have two options here. One is expensive, one is lesser expensive. If we sell the expensive one, we have more money coming in. We buy the cheaper one, we have less money going out. It's a credit. So if we were short the put spread, we might be in a situation where we sell the 30 strike put and we buy the lower strike put, the 25 strike put. When that happens, all we need to do is go to the strike of the short option, which is the higher strike, the upper strike, the 30 strike, right? We sold the 30 put, bought the 25. If we got paid $2 to do that, remember, we got a credit here, bringing money in. If we get paid $2 to do it, we go to that upper strike, the 30 strike, and we subtract the amount of money we collected from the spread. 30 minus 2, 28. So 28 would be our break even. Now, where is our point of maximum profit? For our credit spread, we know where that is. We know that if we have the stock price located directly at the strike of the short option, we are at point of maximum profit. Back to our 25-30 strike example, if we bought the 25-30 call spread, buy the 25s, the lower strike, sell the 30 calls, the upper strike, 1-to-1, same month. If we did that and at expiration the stock was located at 30 or above, the short strike or above, this spread will have maxed out its profit potential. If the stock goes to 90, doesn't matter. We've already made all we can make. It is a limited reward strategy. It's also a limited loss strategy. What if we sold the put spread instead? What if we sold the put spread where we sold the 30 put and bought the 25 put? That's a credit trade. 30 put's going to be trading higher than the 25 put. We sold the higher one, bought the cheaper one. What do we have? We've got a credit. If we have the stock price at the short strike, which again is the upper strike, the 30 strike in this case, or above, our short put spread will have maxed out its value. What you notice here off the bat is the fact that both of these spreads have a maximum profit potential located at the upper strike or above. And what do we know about that? Both have the same upper strike in the example I've been using, the 30 strike. Point of maximum loss. When we're looking at our long call spread, our debit spread, we know we're paying money for it. And we know that whenever we buy something, the most we can lose is the amount we paid. If I pay $3 for a call spread and the stock goes against me, the most I can lose is the $3. If I paid $1 for it, the most I'd lose is $1. Whatever you paid is the most you can lose. That means from a risk management standpoint, we can really control our risk, can't we? Because we can only lose what we spend. Control what you spend, and you've controlled what you might lose. So let's take a look at where this point of maximum loss is for our long call spread, our debit spread, right? We're paying for it, debit. Stock price at long strike, the lower strike, or below. That makes sense in our example, because if we bought the 25-30 call spread, if the stock finished below 25, both options would be out of the money and worthless. The spread would then go to zero. If the spread is at zero and we paid for it, in this case, in our example, we've been saying $3. If we paid $3 for the 25-30 spread and the stock finished below 25, the spread would be worthless. We'd lose our $3. So the point of maximum loss here on our long call spread is the stock at the lower strike or below at expiration. Let's talk about our short put spread, our credit spread. Stock price at long strike, which is the lower strike, or below. If we sold the 25-30 put spread, we know we sold the 30 puts and we bought the 25s. We bought that lower strike. If the stock finished down at 25 or below, at 25 exactly, the 25 put would be worthless. The 30 put, however, would now be worth $5. That spread that I just sold for $2 is now worth $5. I lost $3. If you notice, both spreads under these examples lost the same amount. Pay attention to that. Here is our chart of our bull spread. What we see here is our limited potential gain, our limited potential loss. Stock goes up, we're making money up to a limit. Stock goes down, we'll lose money, but only a certain amount. And that is how much? Well, how much the spread is worth down here is going to be 0 on the call spread, 5 on the put spread. So, point of break even. What are these two? Right there and there, those two little bends, what do you think they are? Well, obviously, this is the point of maximum profit. This must be the 30 strike. Here's the point of maximum loss. This must be the 25 strike. What is this right in the middle? Half the distance between the 25 strike and the 30 strike. That right there is the 27.5 stock price. Let's talk a little about the minimum and maximum value of a spread, because that is important. The minimum value of a vertical spread is always 0. Nothing can trade below 0. So the value of the spread, when we look at it as to how much could the spread be worth, how little can it be worth, spread, any vertical spread, this goes for all vertical spreads, the minimum value of any vertical spread is always 0. It can't trade negative, so 0 is the bottom. The maximum value of the vertical spread is always the difference between the two strikes. So if we're looking at the 25-30 vertical spread, it's a $5 difference between two strikes. Why is that? One option's value can't exceed the other option's value by anything more than the distance between the two. Think of it like a race. As the stock's running up, the 30 strike is always going to be $5 ahead of the 25 strike. It can't be any more because there's a $5 difference between the two. Once we get to that point, no matter how far we go, the 30 strike will always be $5 ahead of the 25. The 90 strike will be $10 ahead of the 80. So when you're looking at the maximum value of the spread, just take a look at the difference between the two strikes, and that is the spread's maximum value. If you want to figure out how much you can make, if I know the maximum value of a spread is $10 and I paid $3 for it, the maximum I can make would be $7. So it's important to remember that the maximum value of any spread is simply the difference between the two strikes. Well, now that we know what the value is of the spread when the stock is between the two strikes, we have to take a look at something else, another observation. And that is what happens to the value of the spread when the stock is above that midpoint. When the stock is above that midpoint, the value of the spread is actually going to trade at a discount to its intrinsic value. That's an interesting thing. So we know that when the stock is dead center, we're looking at a situation where it's trading at half the value of the 2 strikes. If the stock is above that midpoint, the spread is actually going to trade at a value that is discounted off the intrinsic value. What does that mean? We're looking at the 25-30 strike as our example. Say if the stock was trading at 29, that's above the midpoint. You would look at the 25-30 spread and see something very interesting. You would see that the actual spread, which has how much intrinsic value? $4. It's got $4 of intrinsic value. Why? With the stock trading at 29, the 25 strike would be worth 4 at least. The 30 strike being out of the money has 0 intrinsic value. So the intrinsic value of the spread is $4. But you'll notice that the spread trades for less than that. A discounted value off of the intrinsic value of the spread. So anytime you have a situation where the stock is above that midpoint for the call spread or below the midpoint for the put spread, you'll notice that the spread will be trading at a discount to its intrinsic value. On the other side of the equation, we have premiums. Again, we know that when the stock trades in between the 2 strikes, the value of the spread is half the distance between the 2 strikes. However, if the stock trades below the midpoint for the call spread or above the midpoint for the put spread, we're going to have that spread trading at a premium over its intrinsic value. That's important to know because now I know where the stock needs to be for the spread to be $2.50 in our $5 example, 27.5. If we have the 25-30 strike, stock's at 27.5, I know that spread's worth $2.50. Above it, I know it's worth more than $2.50. But I also know that it's going to be less than its full intrinsic value for the call spread, or if it's below, if we're doing the put spread. I also know that if the stock is trading below 27.5, that for my call spread, I'll be trading at a premium, but for my put spread, it would have to be above 27.5. Just remember, whatever happens in the call spread, the true is opposite of the put spread. Let's talk about potential returns here. Have to remember that any return of investment on the bull spread is simply calculated by taking the amount of money we made and dividing it by the amount of money we risked. Now, that's easy when we're talking about the call spread. Very, very easy. The bull call spread, we know how much we're risking. How much did we pay? That's the debit spread. We're going to sit there and figure out how much we paid, how much we made, and now we know our return on investment. The bull put spread's a little more difficult because we're not paying out money. We're taking a credit in. So what we have to do is figure out how much money we have at risk and then see how much money we made. So for instance, with the bull call spread, if we pay 3 on a $5 spread, we know the maximum value of the spread is 5. We pay 3, we can make 2. We make 2 for the $3 we invested. For the put spread, it's a little different. If we are collecting $2, then we have 3 at risk. So if we made the $2 on our put spread, because the put spread value went to 0 and we sold it at 2, if we make that $2, we have to look at it a little differently. We have to say we made 2, but how much did we risk? We could have lost 3. There's where our return comes. And if you notice, the return would be equivalent on both. They are, after all, the same trade. Let's take a look at the return on a bull call spread. We buy the 60 strike call for $6. Here we are buying the lower strike call, the more valuable one. And we're selling the 65 call for 3, the higher strike. What price did we do the spread for? 6 minus 3 is, you guessed it, 3. We paid $3 for a spread that has a maximum value of 5, the difference between the 2 strikes. Our maximum potential gain then is $2, the difference between the 2 strikes minus the amount of our debit, how much we paid. So we would be able to make $2 on this $3 investment. Not a bad percentage. Our maximum loss is the amount we spent. Remember, whenever we buy something, the most we can lose is what we spent. Our maximum loss here is $3. How? Easy. We pay $3 for the spread. The spread can go to 0 because that's its minimum value. If it goes to 0, we lost the $3 we paid. But this 67% return isn't bad, though, and this could be in 1 month. $2 gained on a $3 investment. Vertical spreads give you not only a high probability, but an excellent return on investment. Now let's look at the bull-put spread. Let's say we buy the 60 put for $1, sell the 65 put for $3. Remember, the 65 put is going to be the more valuable one, right? That's going to be a lot more in the money, or at least closer to in the money. The 60 put, that's the less valuable one. We're selling the more valuable one, buying the less valuable one. Selling for $3, buying for $1, that means we're receiving a $2 credit. So the maximum we can make is $2. You can only make what you sold it for. Our maximum loss, however, is $3. Remember, what's the maximum value of this spread? $5, the difference between the two strikes. If the spread can max out for $5 and we sold it for $2, that means we could lose $3. The maximum value minus what we're going to collect, $3. Maximum loss, $3. Strike differential, difference between the two strikes, minus the credit. But if we do make money, which we're hoping we do, we would make $2 gained on what? $3 risked. There's our risk, $3. What did we make? $2. Same percentage return as the bull call spread. Let's take a look at the Greeks of the bull spread. Well, delta's easy. Bull spread, long delta. Both the long call spread and the short put spread will give us a long delta. What about our gamma? This is a little more iffy. And the reason is because we don't know where the stock's going to be at any given time. We talked about this before when we talked about the collar, didn't we? We said that now that we've got two strikes involved, we need to know where the stock is. If the stock is closer to my long strike, that means that long strike is going to be more at the money. It's going to have a bigger gamma, a bigger theta, a bigger vega than the other option, which is more out of the money or more in the money. Either direction doesn't matter. So my gamma is really going to be determined by the stock's proximity to the two strikes. If we're closer to the lower strike where we're long, then what we're going to see is we're going to see a long gamma. If the stock price is closer to the upper strike, which is the short strike, then we're going to see a negative gamma. But just like the collar, because this is a limited risk, limited reward scenario, we don't really have to worry so much about these Greeks. We already know our maximum gain. We know our maximum loss. It's fixed and limited. We don't really have to worry about these Greeks changing dramatically. And they could. With the stock trading between the two strikes, up $1, we're going to have a short gamma. Down $1, we're going to have a long gamma. It really doesn't matter that much in this single strategy. However, I don't want you getting all bugged out, seeing one day your gamma long, next day your gamma short, and saying, what's going on here? What's my risk? You know your dollar risk just because you understand the value of the spreads. Don't get flipped out. Do understand that your gamma one day might be long, the next day might be short. All depends on where the stock is in proximity to the two strikes. Theta is the exact same way, right? Strike-based Greeks, theta is the same way. If the stock is closer to our long option, it's going to look like our position is decaying because the long option will now be more at the money, having a higher theta than the other strike, which will either be out or in. So we know that no matter where the stock is, that's what's going to be the determinant of what our theta is. If we're up near the short strike, the opposite happens, right? If the stock is up near the short strike, it's going to appear that we're collecting money. Why? Because then our short strike will be more at the money and have a heavier theta than our other strike. And of course, Vega will do the exact same thing. The Vega will be determined by whether or not the stock is closer to my short strike or closer to my long strike. Closer to my long strike, we're going to have a long Vega. Closer to my short strike, we're going to have a short Vega. Again, these are going to change. I don't want you getting, start flipping out when you see these going from negative to positive, because the stock is moving back and forth, one day closer to one strike, the next day closer to the next strike. You already have a limited risk scenario. Remember, the value of the Greeks is to tell us what our risks are and quantify them for us. But we already can do that in the bull spread by another means, the value. We know that the spread can be as low as 0 and never higher than 5. And we know that if we're in between, we're going to be about half that value. We are set and fixed with our risks. We have a limited potential risk, a limited potential reward. So we don't really have to look at the Greeks as much in this strategy. Synthetics. Believe it or not, this bull spread, if you take a look at the chart of the bull spread and take a look at the chart of the collar, the bull spread and the collar are synthetically equivalent. Why is that? Well, think about the construction of your collar. Long stock, short a call, and long a put of the same month but different strikes. If you take your long stock and team it with the short call, long stock, short call gives you a short put. And we still have the long put with it, don't we? We're now what? In a short put spread. If we teamed up in the collar our long stock with the call, with the put, long stock, long put equals long call. What's the other piece of the collar? Short call. Different strike. Bull spread. So the bull spread is actually synthetically equivalent to the collar. Remember in the collar I said you'd probably never put a full collar on? You would probably never go out, buy the stock, sell the call, and buy the put. Go back and take a look. I said it. Why did I say that? Because if you're going to do the collar as a whole, don't do the collar. Don't waste your time bringing in that big stock position. Simply do the bull spread. It's the same thing. That's why I said collars are always legged into. You don't put the collar straight on. Why? Because it's the same thing as the bull spread. Don't spend all that money on the stock. Just do the bull spread. Long call spread equals short put spread. Well, obviously, that is what we're talking about right here. We're talking about the bull spread. Two ways of basically constructing it. Long the call spread equals short the put spread. And we've seen how both of them are making and losing the same amount in our different examples. Give it a try on your sheets. You got those sheets. We gave them to you for a reason. Set the stock at 67.5 and start looking at the 65.70 call spreads and the 65.70 put spreads. And do it for a couple different months. What you're going to see is the value of that spread being right around 250. And if you move in one direction or the other in the stock price, both the long call spread and its short corresponding put spread will make and lose the exact same amount of money in the exact same places because they are synthetically equivalent. You can price one by the other then. If they're synthetically equivalent, we'd be able to price one by the other like we do with all of our other synthetic positions. The absolute value of the call spread plus the absolute value of the corresponding put spread is going to equal the difference between the two strikes. What does that mean? If the call spread is currently trading for $3 and we've got a $5 wide spread, if the call spread's worth 3, the put spread will be worth 2. Why? Well, 3 plus 2 equals 5. Okay, yes, that is the formula. But if the call spread is worth 3 come expiration, It means that the in-the-money call must be $3 in the money. If that's true, then the in-the-money put of the other spread must be worth 2. Let's see how that works. Let's take our example of the 25-30 spread. And let's say the stock closes at 28. We would look at our spread and say, okay, let me look at the call spread. The 25 strike would now be in the money with the stock at 28. And it would be worth $3, right? $3 in the money. The stock is 28. I have the right to buy at 25. $3 difference, intrinsic value. So the call spread would have the lower strikes intrinsic value, the 25 strikes intrinsic value. But what about the put spread? With the stock at 28, the 25-30 put spread would have the 25 puts out of the money and worthless, but the 30 puts would be in the money, wouldn't they? How much in the money are they? 2. The spread would trade for the value of the intrinsic value of that in the money put. So now we've got the stock at 28, the call spread worth 3, the put spread worth 2. 3 and 2, 5. Works every time. Try that at home on some of your sheets. Do a little homework. Now, that means we could price one by the other. So if we're looking at a $5 spread and the call spread's trading for 4, what must the put spread be worth? 1. If we're looking at a $10 spread and the put spread is worth 7, what must be the call spread's value? 3. $10 wide spread, 10 minus 7, 3. Now, we're going to have to talk about this, the box. We know that whenever you have two positions that are synthetically equivalent, you could buy one, sell the other, and set up the arbitrage. That's what the reversal and the conversion were about. Taking the real value of the option, of the real value, and then looking at its synthetic equivalent and saying, hey, if these two things are truly equal, their effective cost should be the same. If they're not, an arbitrage sets up. Same here with the box. The value of the call spread plus the value of the put spread has to equal the difference between the two strikes. If it doesn't, then something is skewed. And that sets up the potential of an arbitrage. That arbitrage is known as the box. So the box is a way that we can figure out whether or not the call spread or the put spread is actually priced properly or if it's out of line. So how do we construct the box? Easy. It's a long vertical call spread plus a long vertical put spread, or short a vertical call spread and short the corresponding vertical put spread. You have to remember that these must be corresponding. If I'm talking about being long the June 25-30 call spread, I've got to then buy the June 25-30 put spread. That will create a box. You'll see why it works in a minute. Meanwhile, on the other side of the equation, we could either be short the vertical call spread and short the corresponding vertical put spread. This creates an arbitrage, and you'll see how that arbitrage plays out in a minute. So, think about what we're doing here. If we know that the long vertical call spread is the same thing as the short put spread, and we know that the long put spread closes the short put spread, then the long put spread will close the long call spread. If I'm long the call spread, I could just, of course, sell it out. I got my profit, I sell it out. But there's a second way out, and that is to buy the corresponding put spread. Believe it or not, this works. It looks crazy, but it works. Why? Because we know that the long call spread and the short corresponding put spread are both bull spreads. And we showed how they were identical, right? They made and lost the same amount of money at each spot. We know that if these two are identical and this closes this, then this has to close that. Simple as that, although sounding very complicated. The nice thing about the vertical spread is it is very flexible. And if you can't really find a more flexible strategy than the vertical spread, You've got two different spreads, both bull spreads constructed different ways, one using calls, one using puts, and we know they're equivalent. That means that the opposites of each of those not only close down what you have, but it closes down the other side of the bull spread. So we know the long call is equal to the short put. If the long put shuts down the short put, then the long put must also shut down the long call, because the long call and the short put are equal. They're the same thing. So we could shut down our vertical spreads in two different ways. Now, what's the nature of the position of the box? When you think about the box, have in your mind reversals and conversions. There's going to be another one that I'm going to be throwing in a little later when we talk about time spreads. But when we look at the different arbitrages in the option market, we've got the reversals and the conversions. And they were basically a synthetic position against its real opposite position. And we have the box. Two vertical spreads. One call spread, which is going to be a bull spread. One put spread, which is going to be a bear spread. Long call spread, bull spread. Long put spread, bear spread. These two combined cancel each other out. Short call spread. Now remember, a short call spread will give us what kind of delta? Short. It's going to be a bear spread. Short put spread, we've just gone over that one. That's a bull spread because it's going to give us a long delta. These two, bear, bull, cancel each other out. So the combination of the two here cancel each other out, allowing us to close down each position we have in more than one way. Two ways to be exact. So if I'm long a call spread, that's a bull spread. If I'm long the call spread, I can sell that call spread out, or I can actually buy the corresponding put spread to close it out. And I'll show you why that works in a minute. So this position is an arbitrage, this box. Long the call spread and long the corresponding put spread, or short the call spread and short its corresponding put spread. Combined, they create a box. And it's an arbitrage. It's a position with no position. So there's a synthetic foundation to all this. You've got to have an idea of what we're looking at here. The long call spread is equal to the short corresponding put spread, right? We're talking about that right now, the bull spread. The long call spread is a bull spread. The short corresponding put spread is also a bull spread, and we showed how those two are identical. They're synthetic positions. That means that if the long put spread closes out the short put spread, and the short put spread is equal to the long call spread, then that long put spread will also close the long call spread. That's how it works. So now I've got two ways of getting out of my bull spread. I could just simply sell out my bull spread, or I can buy a bear spread that neutralizes the bull spread. So why do I want to use this box? What are the uses for it? Now that we see how it works, what do we have? Well, number one, it's used for making sure that the pricing of the spreads are accurate, because the price of one indicates the other. I know that if I have a $5 spread, maximum $5 wide, and I buy the call spread for $3, I know the put spread has to be worth $2. So if the put spread's not worth $2, then something is out of line. That means either my call spread is too expensive or my put spread is too expensive. If the situation is my call spread's worth 3 and my put spread's worth over 2, then one of these two spreads would be too expensive, overpriced. Which one, we don't know, but one of them will be. What if my call spread plus my put spread equaled less than 5? That means one of those two spreads is too cheap. So the price of one indicates the value of the other. Used for determining best entry constructions. Well, now that we know that there's a mathematical relationship between the values, we can now decide, hey, Do I buy the call spread for my bull spread, or do I sell the put spread? Which one should I do? The box is going to tell us which one to do. If I sit there and I decide I want to buy my call spread, and I look at the put spread and I say, oh, the put spread plus my call spread equals more than 5. I know one of those two spreads is overvalued, but I don't know which one. So if it's overvalued, one of them's overvalued, and I don't know which one, I don't want to be a buyer here, because one of the two spreads is going to move down. And if they move down, the market that is, if the market moves down my spread that I bought, I'm going to lose. So what do? Instead of buying the call spread, I'm going to sell the put spread, because if they move my put spread down, I'm going to benefit because I'm short it. So think about that. I have a choice of buying the call spread or selling the put spread. I take a look at the box, and the box adds up for over $5. And let's just pretend we have a $5 spread. If it was a $10 spread, we'd be looking at the $10 box. But we're looking at a $5 box here in this example, and I have a decision to make. Which one am I going to do? Well, if the box is priced over the difference between the two strikes, over 5 in this example, then what I'm going to do is I'm going to select the credit spread. Why? Because if I'm going to be long one or short one, and I know that they're going to move the value down of one of them, I want to make sure that I'm not a buyer, because there's a chance that they're going to move my spread down. If I'm a seller and I do the credit spread, sell the corresponding put spread instead of buying the call spread, then if they move mine down, I benefit. So that's what we're going to do if the box adds up to over 5. If the box is under 5, that means they're going to move something up. I want to buy the call spread in that case, because if they move up my call spread that I own, I benefit, I make money. But if I had sold the put spread with the box under 5, they're going to move something up. If they move my put spread up, the one I sold, I'm going to see a loss. So this is going to determine which one of the bull spreads we are going to enter. It also gives me the idea of which one we're going to exit by. Remember, if I have a call spread that I'm long, I could either sell out that call spread, or I can buy the corresponding put spread. Because remember, my call spread here, the one I'm long, that's a bull spread. If I buy a put spread, that's going to be a bear spread. We're going to talk about bear spreads coming up. But a bull spread and a bear spread that are both of the same strikes and synthetically equivalent, one long, one short, cancel each other out. I've got two ways out of this. So what I have is the ability to use the box to determine which one is effectively cheaper. Which bull spread do I want to do that's effectively cheaper when I'm going in? Do I want to be a buyer when the box is below 5? Then I do the call. I buy the call spread. I want to be a seller when the box is over 5. I want to sell the put spread. So either way, I'm going to get into my bull spread in the best price. I can then also exit at the best price. If the call spread is higher and I'm long the call spread, I sell the call spread out. If the corresponding put spread is lower, I can actually buy the put spread to cancel out my call spread. There's a lot of different ways out of the vertical, and we want to try to do it in the most cost-effective, benefiting way to us. Whether that's either buying the call spread, I sell the call spread, or buying the call spread, I buy the put spread. We have either way of doing it. So we can get out of our bull spreads in multiple ways. We just use the box to determine what the value of each way is and which way getting in at the lowest cost-effective price and out at the highest cost-effective price benefits us. Obviously, we've got a little bit of the old adage, buy low and sell high. And the box lets us figure out which is high and which is low in the bull spread. Now, we've seen how the box works or how the box is in relation to our first bull spread, the long call spread. But what if we decided to put on a bull spread, and instead of buying the call spread, we decided to sell the corresponding put spread? The short put vertical, that is also a bull spread, isn't it? Short the put, negative instrument, what are we doing? We're getting shorted, negative times the negative, positive. It's a positive delta spread, the short put spread. And when we set up our short put spread, we're going to be short the May 30 put, long the May 25 put. That's a bull spread. Now we know we can simply just buy it back. We can buy back our short May 30 put, sell out our long May 25 put, boom, we're out. But understanding the box, we know there's a second way out of this. We could actually short the call spread. If we short the call spread, we create a box. Why is this a box? Why is it an arbitrage? Combine the two. Combine your put spread with the corresponding call spread. Look at the individual components, and let's look at the strikes. Long the May 25 put, short the May 25 call. 1-to-1 ratio, corresponding options, same month and strike. That is a short stock position. Short synthetic stock. But now we look at the May 30s. Short the May 30 put, long the May 30 call, 1-to-1, that's long stock. Long call, short put is long stock. When we combine these, we have a synthetic short stock position and an equally sized synthetic long stock position. That's how they cancel into the arbitrage. We have the box there. And what was the value? Oh, what's the value of that box? $5, right? Okay.